What's up everybody, it's Imad, and welcome back to the channel. Today, we're diving deep into the world of investing, and more importantly, the common mistakes that can trip up new investors. Look, I get it. Starting your investment journey can feel like navigating a minefield, and the last thing you want is to make costly mistakes. But the good news is, with a little bit of knowledge and a focus on the right strategies, you can avoid these pitfalls and set yourself up for success. We'll be covering the most common mistakes new investors make, breaking them down so you understand why they happen and how to avoid them. From not having a plan to chasing hot stocks and everything in between, we're going to give you the tools and insights you need to invest with confidence. Remember, investing is a marathon, not a sprint, and the key is to make informed decisions that align with your financial goals. So whether you're just starting out or have been investing for a while, this video is packed with valuable information to help you become a smarter, more confident investor. Let's get started. One of the biggest mistakes I see new investors make is jumping into the market without a clear plan. It's like setting out on a road trip without a map or GPS. You might eventually reach your destination, but you'll likely encounter detours, dead ends, and unnecessary stress along the way. Having a well-defined investment plan is crucial for a number of reasons. First, it forces you to define your financial goals. Are you saving for retirement, a down payment on a house, your kids' college education? Knowing your goals will help you determine how much to invest, what to invest in, and how much risk you're comfortable taking. Second, a plan helps you stay focused and disciplined. The market can be volatile, and it's easy to get caught up in the emotional roller coaster of daily fluctuations. But if you have a plan, you're less likely to make impulsive decisions based on fear or greed. Think of your investment plan as your roadmap to financial success. It should outline your investment goals, risk tolerance, time horizon, and asset allocation strategy. And remember, your plan isn't set in stone. It's important to review and adjust it periodically as your circumstances change. Don't put all your eggs in one basket. We've all heard that saying before, and it couldn't be truer when it comes to investing. Diversification is essentially spreading your money across different asset classes such as stocks, bonds, real estate, and commodities. The idea behind diversification is simple. If one investment performs poorly, the others can help cushion the blow. By diversifying your portfolio, you're reducing your overall risk without necessarily sacrificing returns. Imagine you invest all your money in a single stock, and that company ends up going bankrupt. You could lose everything. But if you had diversified your portfolio, the loss from that one stock would be offset by the gains, or smaller losses, from your other investments. There are countless ways to diversify your portfolio. You can invest in different sectors, industries, and geographic regions. You can also choose from a variety of investment vehicles such as mutual funds, exchange-traded funds, ETFs, and individual stocks and bonds. The key is to find a mix of investments that aligns with your risk tolerance and investment goals. Trying to time the market is like trying to predict when lightning will strike. Sure, some people might get lucky, but for the vast majority of us, it's a fool's errand. Even professional investors with years of experience and access to sophisticated tools struggle to consistently time the market correctly. The problem is that the market is inherently unpredictable. There are countless factors that can influence stock prices in the short term, many of which are impossible to foresee. By trying to time the market, you're essentially betting against the odds. Instead of trying to predict when to buy and sell, focus on a strategy called time in the market. This means investing consistently over time, regardless of market conditions. By staying invested for the long term, you benefit from the power of compounding, which is essentially earning interest on your interest. Remember, investing is a marathon, not a sprint. Trying to time the market is a recipe for stress and often leads to poor investment decisions. Focus on the long game and let the power of compounding work its magic. Fees and expenses might seem like small potatoes, especially when you're first starting out. But over time they can eat into your returns like termites in a wooden frame. It's like paying for a gourmet meal and only getting a few bites. There are all sorts of fees associated with investing, including trading commissions, expense ratios on mutual funds and ETFs, and advisory fees if you work with a financial advisor. It's crucial to understand all the fees you're paying and how they impact your overall returns. For example, let's say you invest $10,000 in a mutual fund with an expense ratio of 1%. That means you're paying $100 per year in fees. Over 30 years, those fees could add up to over $3,000. The good news is that there are plenty of low-cost investment options available, such as index funds and ETFs. By choosing low-cost investments, you can keep more of your hard-earned money working for you. It's tempting to follow the herd when it comes to investing. After all, if everyone else is buying a particular stock or investing in a certain sector, it must be a good idea, right? Wrong. Following the crowd or herd mentality can lead to poor investment decisions. When everyone is buying, prices tend to be inflated, and you risk buying high and selling low. Remember the dot-com bubble? Investors piled into tech stocks, driving prices to unsustainable levels, and when the bubble burst, countless investors lost their shirts. Instead of following the herd, do your own research and make independent investment decisions. Don't be afraid to go against the grain if you believe in an investment. Remember, Warren Buffett made his fortune by being a contrarian investor, often buying when everyone else was selling. Investing in something you don't understand is like buying a book in a language you can't read. You might like the cover, but you'll have no idea what's inside. Before investing in anything, it's crucial to understand what you're buying. What does the company do? How does it make money? What are its growth prospects? What are the risks involved? Don't be afraid to ask questions. If you're working with a financial advisor, don't be afraid to ask them to explain things you don't understand. If you're researching investments on your own, take the time to read company filings, analyst reports, and industry publications. The more you understand about your investments, the better equipped you'll be to make informed decisions. Investing in emotions are like oil and water, they just don't mix. When you let your emotions dictate your investment decisions, you're more likely to make costly mistakes. Fear and greed are two of the most powerful emotions that can influence investors. When the market is down, it's easy to get caught up in the fear and sell everything, but honestly, panic selling is rarely a good idea. On the other hand, when the market is soaring, it's easy to get caught up in the greed and chase returns, but chasing hot stocks or sectors can lead to buying high and selling low. Remember, the market tends to move in cycles. What goes up must come down, and, well, vice versa. The key to successful investing is to stay disciplined and stick to your plan. Don't let your emotions cloud your judgment. Rebalancing your portfolio is like getting a regular tune-up for your car. It helps keep everything running smoothly and prevents small problems from becoming big ones. Over time, your asset allocation will likely drift from your original target. For example, let's say you started with a portfolio of 60% stocks and 40% bonds. But after a few years of strong stock market performance, your portfolio might be 80% stocks and 20% bonds. Rebalancing involves selling some of your winners and reinvesting the proceeds in your laggards to bring your portfolio back to its target allocation. This helps you manage risk and stay on track to reach your financial goals. How often you rebalance depends on your risk tolerance, time horizon, and how much your portfolio has drifted from its target allocation. Some investors rebalance annually, while others rebalance quarterly or even monthly. Taxes are like that annoying friend who always shows up uninvited. You can't avoid them, but you can minimize their impact. Different types of investments are taxed differently. For example, long-term capital gains, profits from investments held for more than a year, are taxed at a lower rate than short-term capital gains. And dividends, which are payments made by companies to their shareholders, are also taxed. There are a number of strategies you can use to minimize your tax liability, such as investing in tax-advantaged accounts like 401(k)s and IRAs. You can also offset capital gains with capital losses. It's important to consult with a tax professional to develop a tax-efficient investment strategy. The best time to plant a tree was 20 years ago. The second best time is today. The same goes for investing. The earlier you start investing, the more time your money has to grow. This is due to the power of compounding, which Albert Einstein once called the eighth wonder of the world. Compounding is essentially earning interest on your interest. The longer your money compounds, the more it grows exponentially. Even if you can only invest a small amount each month, starting early can make a huge difference in the long run. So don't wait. The sooner you start, the better. There you have it, the top 10 mistakes new investors make. Remember, investing doesn't have to be complicated or intimidating. By understanding these common pitfalls and taking a thoughtful, strategic approach, you can set yourself up for long-term financial success. Don't let these mistakes discourage you. Instead, use them as learning opportunities to become a smarter, more confident investor. Remember, the key is to start early, invest consistently, and stay disciplined. If you found this video helpful, please give it a thumbs up and subscribe to the channel for more videos like this. And be sure to let me know in the comments what other investing topics you'd like me to cover. Thanks for watching.